Okay, everybody, welcome. If you're just tuning in, I want to welcome you to our Friday Night Wealth Creation course. Every Friday night we do these. I've been doing these every single week for going on 3 years now. And tonight's topic is one of my favorites. Okay, it's how to reduce taxes. Okay, I don't know anybody that likes paying taxes. I don't like paying taxes. I don't know any of my clients that like paying taxes. And so the goal is we want to pay as little as possible, and we want to do it legally using the law, the tax code, to do so. Okay, so a little bit that I'm going to give you tonight is the fundamentals and basics. I've covered before some advanced stuff on how to go about this, but what I want to make sure we have down is the basics of how taxes work. Okay, how taxes work and what do I need to know, right, in order to reduce them. Okay, because there's a lot of things that I could do. There's a lot of advanced stuff that I could hear about. There's a lot of strategies out there. But if I don't have my footing underneath of me, okay, if I don't have my feet on something stable, I can't make any of those moves, right? And so that's really what it's about. Now, again, I've been in the financial services industry as a professional, as an advisor for almost 10 years now. I think this is my 8th or 9th year. And when I first started doing this, I used to look at tax returns and get utterly confused. Okay, I would look at a client's tax return. Shoot, I would look at my own tax return, and it would just be like blurry, and I didn't know what it meant, and it was just overwhelming to look at. Okay, so what I want to go over tonight is the basics and the fundamentals so that when you look at your taxes, you know what you're looking at. When I see it, I understand what it says, I understand what it means, and I know how to go about reducing them, right? Because that's the whole goal here. So a couple of house rules as we're going through this. Okay, first thing, if there's anything I go over, guys, anything at all that doesn't make sense, I say a word you don't understand, I go over a phrase and you're not sure what it means, don't feel stupid. Just ask me what it means and tell me that you didn't understand something. You can do that in the comments and I will stop and I will answer that for you. Okay. Second thing is ask your questions in the comments. Okay, I will answer questions at the very end. I always do. So the last 5-10 minutes, we'll go over questions. And so I'll go ahead and answer all those for you. And again, we're talking about taxes. So really try and think with questions related to your taxes, right? And then the third thing, again, this is mostly for Instagram because Facebook is not as bad as you guys. Every Friday night, there are two groups that come on here. There's the group of people that dedicate their Friday night to learning about their money, and they actually stayed in and they didn't go out with their friends and they didn't party and they didn't do whatever people would be doing on a Friday because they care. They want to learn about finances and they know that this is a place they can do it. So they take their time where they could be having fun and invest it. That's what investing is, right? So they're investing their time here tonight to learn because it matters. There's also a group of people that they didn't get invited to anything on Friday. So they're at home alone and the only thing they have is a smartphone, and they've already played too much Fortnite and they've already watched too much porn and they don't have anything better to do. And so they're going to get on Instagram and they're going to creep and troll and be negative. If you're the second group, this is not your course. It's not for you tonight. So don't ruin it for the first group. Okay, that's my rule there. If you do, we're not even gonna acknowledge you. You're just out, right? So what we're gonna cover tonight is taxes. Growing up, I didn't even know what that was, right? As a little kid, I didn't understand taxes. I didn't learn about taxes until very rudely, my very first paycheck. Okay, who remembers their first paycheck where you, and not a cash under the table paycheck. I mean your first W-2 paycheck, where I had a pizza job. I worked at the pizza job and I got paid and I thought I made $1,000 and I get my paycheck and there's $200 missing. And I only have $800 and I know that I just worked and made 1,000 and I'm looking, trying to figure out where that $200 went. I thought maybe my boss stole it from me or forgot my hours or somehow I got gypped. And then I saw taxes, federal taxes, FICA, FUTA, those are all your Social Security and Medicare taxes. I see those and I look at them and I see that that's where my $200 went. And that was my first experience with taxes. Okay, and I remember being a little bit confused about it. No one ever prepared me for it. No one ever told me what it was. I didn't understand where they go. So I had this being taken out of my check. And so I'm looking at this and I'm like, man, so I have to work even harder to get the 1,000 that I should have already got because this stuff came out of my check and I've only got $800 now. I've got to go make up the other 200. Okay, and then I started hearing horror stories from my employee, like my employee friends that were always also working at the pizza joint, you know, like because we're doing pizza, so there's under the table tips. You get cash tips. You don't report those. Most people don't because they don't want to pay taxes on it. But I start hearing the horror stories of like, man, you really need to be reporting your tips because you know if you get audited by the IRS, you really could be in big trouble. And that was the first time I heard of the IRS and the idea of being audited. And it struck fear into my soul. As an 18-year-old, 19-year-old kid, I'm like, man, so there's this thing called taxes and I have to pay it and it's illegal not to. And if I don't, I could get audited and go to jail. I could I could end up like Willie Nelson. I don't want to do that, right? So I have kind of this initially in life, this fear of taxes. It's a thing where it's enforced. It's very authoritative. You have to, you're supposed to, it's illegal not to, that kind of a thing. And then there's a bad thing that happens if I don't pay them. And I don't know anything else other than that. Right. So what I want to go over tonight is how do we clear that out? I talked to a family just a couple of days ago, actually, and they were afraid of like finding legal ways to not pay taxes. Okay, they were afraid of finding legal ways not to pay taxes. And so I had to go over with them like, hey, there's illegal ways to do it and there's legal ways to do it. We're not talking about illegal stuff tonight. I'm never going to tell you to do something illegal. We're only doing legal things. Okay, so we have to go into basically what are taxes, right? So taxes are a revenue collected by our federal government from us as citizens. It's basically a royalty that we pay them on our income in order to be citizens here. It's a fee that they charge, a percentage of our income that we have to pay. Okay, before we had income taxes, it was on tariffs like, you know, exports, imports, you know, goods, services, buying, selling. And then later on in 1913, we got income tax where they're like, hey, straight up, if you earn money, you've got to pay the US government. Okay. Now, the US Treasury is where that money goes to. Our government has a treasury. A treasury is the people that manage the money. They're very bad at it, but they do have a treasury. They do have a treasury here in the US. And then the treasury has a collection agency called the IRS, Internal Revenue Service. This collection agency's job is to make sure that the taxpayer pays what they owe to the US Treasury. Okay, that's the basics of it. Okay, so someone put crying faces on Instagram. I totally agree. By the way, I don't like tax. I think it's theft. Taxation straight up is theft. We're not going to dive into the conspiracies around it and any of that stuff. We're going to talk about how do you legally get out of it, right? So when you look at that, you have to then get into, okay, well, the taxes go to the Treasury. It's from the IRS. What is it based on? Okay, so we have this thing in the United States called the Internal Revenue Code. It's this law. It's a number of laws, a big book, thousands upon thousands of pages. I think it's 5,000 or 6,000 pages long of codes and rules and laws about taxes. Okay, the example that I saw in the illustration I saw was that if you printed it out and you lined up all of the pages back to back to back to back to back, and then you fired a bullet into it, the bullet would not make it through the other side. Just to give you that to think with, that's how thick the tax code is. That's how much is in there. Okay. Now, here's the kicker. Okay. We talked about the Treasury and we talked about the IRS. The IRS did not write the tax code. Okay. A lot of us think when we think taxes, we automatically think IRS and we're like, oh, that's their thing. No. They didn't write the tax code. Their job is to enforce the tax code. They're the police for taxes, right? They're border control for taxes. Like their job is just to make sure that you follow the rules in the tax code. That's all the IRS does. You follow the rules and you pay what's owed. And if you don't, that's where we get in trouble, right? So I started looking at, okay, if the IRS didn't write it, who wrote it? Who wrote the tax code? And as I started doing research, again, the IRS, I looked at the Treasury and I was like, did the Treasury write it? Nope, the Treasury did not write it. And then I realized that the tax code is law. Laws get passed with Congress and through our political system. So then I looked at Congress and the House of Representatives, like, okay, they're the ones that pass these laws. Okay, but who writes the laws? Who writes the laws in the tax code? If you haven't figured out yet, the way that our government works is we have our Congress and House of Representatives and senators and all that stuff. There's these things called lobbyists. Okay, lobbyists are basically like political prostitution. They will take an idea from a business or a corporation or a trust that wants something to be in law, and they'll go court a Congress member or a representative or a senator, and they'll bribe them, they'll wine and dine them, they'll make sure that they get campaign donations. If this law that their payer wants in the tax code gets in the tax code. So they do have lawyers. There's lawyers that write these, but they work for corporations. So the flow is a corporation, an owner of a corporation, shareholder, trust, whoever says, man, I really wish that there was this tax code, there was this law, because if this law was in effect, I wouldn't have to pay taxes. Good thing I'm wealthy, because I can just pay a lobbyist to go court a politician and get that politician to sponsor this as a bill. And if that bill gets passed, it can now go into the tax code. So when I traced all of that back, I realized the wealthy wrote the tax code. Okay, the wealthy wrote the tax code. The business owners, the investors, Wall Street, banks, they're responsible for what's in the tax code. And the proof here is, like I said, the tax code itself is over like 5,000 or 6,000 pages. Only about 50 or 60 pages of the entire thing is devoted to the paying of income tax. Literally like 5,000 or 6,000 pages, and this much of it has to do with paying taxes, which means by default, the rest of it has to do with not paying taxes. Okay, so why would we have a tax code where it's literally like 0.50% of it is about paying taxes and the other 99.50% is not paying taxes and legally not paying taxes? Okay, so this is all like the basic stuff we've got to understand, because the limiting belief of I can't find ways to reduce my taxes and it's illegal and I'll get in trouble. No, the entire code is about not paying. It was written by the wealthy for the wealthy. There's a reason why it takes lawyers and CPAs to make sense and decipher what it says. They don't want the average person to know this stuff. This was not ever meant to get in the hands of you and me. If it was, it would be simple. And it's not simple. So that means that somebody's hiding it because they don't want us to know about it, because they're using it. And if everyone uses it, its value goes down and it can no longer be a workable thing, right? I'm not political at all, but you look at Donald Trump, I still don't think he has shown his tax returns. Okay, there's a reason why. I'm going to go over brackets here. There's a reason why, and it's actually very good timing because we have all this presidential election talk coming, and there's always going to be we're going to raise taxes on the rich people so you can stick it to them, and that way everyone else feels better about their tax situation and the fact that they don't make as much money as the rich people. I'm going to go over how the rich people don't actually pay the taxes we think they pay. And that's not a bad thing. That's actually what you and I should be doing too. Okay, so I'm going to share my screen. And what I want to do is just go over basics with you on the tax brackets themselves. Okay, so let me share my screen with you guys here tonight. Okay, so everyone should be able to see this on Facebook and Zoom. Let me flip Instagram around. Okay, this is called the tax triangle. These are different brackets. Okay, I know that this looks overwhelming at first, but I want to go through this, bit by bit. If we divide this in half, we have two sides here. This side over here is for single people. Okay, so this is for single filers, people that are not married. This is the rules that pertain to a single filer. This side over here is for married couples that are filing jointly. Okay, so if you're married, then you're filing jointly with your spouse on your tax return. These are the rules that apply to you. Now, the ones that we're not going to cover are head of household, and we're not going to cover married filing separately. If you're married filing separately, you're getting screwed. That's all I can say. So we're not going to cover those. We're going to cover the main ones, which is single and joint. Single and joint, right? So what we see here is we see different brackets. We have the 10% bracket. We have the 12% bracket. We have the 22% bracket, 24% bracket, 32% bracket, 35% bracket, and 37% bracket, which is the highest bracket we have up here. This is only federal, so we're not talking state taxes. Okay, so the way that this works is we have different brackets here. So next to these brackets, you're going to see some income levels. Okay, what this is saying is these different income levels are the thresholds to each bracket. Okay, so when I earn income, I have something on my taxes called adjustable gross income. Okay, that's my income prior to me taking deductions. Okay, you'll see here this term standard deduction. Okay, I can do deductions. I can do something called an itemized deduction, which means I count up all of my personal expenses that I could write off on my taxes, and then I write them off. Or I could do something called a standard deduction. The standard deduction is what the IRS is going to give me anyways. So if I'm trying to itemize, I would have to spend more than $24,800 in order to actually get more than I'm going to get anyways. Meaning if I don't have more than $24,800 in itemized deductions, I shouldn't even try to, because I'm not going to get as much versus if I do the standard. If I'm single, the standard deduction is $12,400. Right, so I'm going to get $12,400 in free deductions, whether I actually spent that or not. And if I'm trying to itemize, I need to actually spend more than that. So I need to be spending about $1,000 a month on tax deductible things in my personal life in order to write that off as a deduction. Okay, so we have our adjusted gross income. Right, let's say that I'm in here. My adjusted gross income is $171,000, and that puts me in the 22% bracket. If I take a standard deduction, 171 minus my standard deduction of 24.8 puts me at 105,050. This is called taxable income. Taxable income is adjusted gross income minus the standard or the itemized deduction. So that's actually what I'm going to pay taxes on. Now, the way that this works is it works in layers. So if I made $105,000 or more, that puts me in a 22% bracket, which means anything above 105 grand up to 195 grand is going to be taxed at 22%. Okay, anything below 105 puts me down in the 12% bracket. That threshold is $44,000 up to 105. So if I'm making anywhere from 44 grand to 105 grand as a married joint filer, I'm going to pay 12% on my tax bracket on that income. Okay, and then anything I make below 40,000 or 44,000 is going to put me at 10%. Right, so those are my brackets. So what happens is if I make 105, my first 44,000 gets taxed at 10%. Okay, from that up to 105 gets taxed at 12%. From that up to 195 gets taxed at 22%. This is like a layer cake, right? Who likes layer cakes? I like layer cakes. Not when they're taxes though. I like to have no layers in my tax cake because that means I pay less. But in this, it goes up. The more income I earn, that chunk of income is subject to a higher bracket. Okay, now if I'm single, it's going to be a little bit different. Single is one of the worst brackets you can be in. Okay, our government likes people to get married, so they incentivize marriage by reducing taxes. Someone says, I feel like I'm in a class. You're totally in a class. You're in a financial class. Enjoy it. Ask questions. So if I'm single, if I'm going to be in the 37% bracket, I need to have at least 530 grand in income, in taxable income after I've taken my itemized or my standard deduction. Anything above 530 grand is going to be taxed at 37%, right? If I'm at 219, 750 or higher, anything between that and the 530 gets taxed at 35%, right? If I'm at 175.7 up to the 219, that's going to be taxed at 32%. This is kind of getting redundant. If I'm at 97,925, anything from there up to 175 gets taxed at 24%. If I am at 52,525, anything between that and 97 gets taxed at 22%. And then anything between 22,275 and 52,525 gets taxed at 12%. And then finally, my lowest bracket, if I make less than $22,000, I get taxed at 10%. Okay, so I know that's a lot, but what happens with this is we have our incomes show up, and I'm actually going to whiteboard this because this is going to be a great illustration here. We have our income, adjustable gross income showing up here. We have our, we're just going to call this AGI, adjustable gross income. Let me get rid of this thing here. AGI, and then we're going to subtract out our deduction, right? So we're either going to take a standard deduction or we're going to take an itemized deduction. Okay, itemized again means that I actually, if I'm married, I did spend more than 24,800 in qualified deductions and I can take all that out. Okay, so my AGI minus this number equals my taxable income. This is what I'm going to pay income tax on. Super simple, right? Like the only thing confusing about this is the terms. Who would agree with that? AGI, that's a confusing term. Adjustable gross income is what that means. If we clear that up though, and we just say, well, this is what I made in taxable income before I took my deductions, now it makes sense. It's just addition and subtraction. This is what I made. This is what I can deduct. This is what is eligible to be taxed. That's it, right? So logic stands to reason. This number here, we want that to be as low as possible. That's my taxable income. So if I can drop my taxable income down, that's the name of the game, then I'm going to pay a lower bracket on less income, meaning I pay less income tax, right? So basically what I want to do here is I want to show you some examples on this. And again, guys, I ask lots of questions. Like if you have questions on this, you feel lost, drop questions in the comments, ask tons of questions. I want to be able to answer everything you guys have tonight. But let's say that I am here. Let's say I'm an average American, working family, and I'm making, somewhere between 40 and 100 grand a year. Okay, what that means is all of my income, if it's taxable income, meaning I took my deduction and I'm still in this range, all of my income above 44 grand gets taxed at 12%. Okay, where could I invest to get a guaranteed 12% return? Not very many places, right? But what this is saying is every single dollar that I can deduct is a guaranteed 12% tax deduction, meaning my taxes will go down at a ratio of 12 cents on every dollar that I can get rid of off of my taxable income. So I'm highly incentivized to find ways to reduce that because I make a 12% return every time. Now, what we don't want to do here is we don't want to spend a dollar to save 12 cents, right? So we're looking for what are smart things I would do with that dollar anyways that also reduce my taxes. So I'm not going to be like, hey, let me go buy, a car for my business when my business does not need a car because I already have one, just in the name of writing off 12% of my taxes. We don't want to do that. We want to look at what are things I'm going to do anyways. Maybe I'm investing, maybe I'm saving, maybe I'm investing in growing my business. If I'm going to spend money on those things anyways, how do I get that to qualify to become a tax deductible event? Okay. Now, the other thing that we haven't talked about here is we have two types of earnings, right? Within taxable income, we have people that are W-2 income, meaning I would be an employee. I'm an employee at a company, or we would have 1099 income, which means I'm self-employed or I'm an independent contractor, or we could even have something called K1 income, which means I own a corporation and it pays out bonuses or it pays out distributions to me as an owner, right? If I'm a K1 or a 1099, I'm always going to have more tax deductions than a W-2 worker. Sorry to say, that's just the way that it is, okay? So let me just jot this down again for you on the whiteboard. So if I'm W-2 employee, I'm going to have less deductions. Okay, this is what's crazy, and this is why I'm in California right now. This is why California wants everyone to be on a W-2. They're trying to outlaw 1099s for businesses because a W-2 means less deductions. Okay, what does less deductions mean? Less deductions means higher taxable income. So if I can't take as many deductions, then the IRS gets more money. The state gets more money. So they're incentivized to try and keep me on W-2. Okay, the W-2 has only been around since like the 1940s, I want to say. And in the 40s, when it was invented, if you look this up, the sole purpose of W-2 income was so that the IRS could have direct collection of taxes from an employee's paycheck. That is the only reason W-2 income exists. The IRS did not want to be able to have you be able to say, no, I'll just pay you at the end of the year. They don't trust you. So they won't, if I'm W-2, they're like, hey, I am going to take this out of your check. And because you're W-2, that's how it has to be. Okay, if I'm a business owner, I don't have to do that. If I'm a 1099, I don't have to do that. They don't withhold income from my checks. Only for W-2s do they do this. So the W-2 is direct collection off the paycheck and I get less deductions. Okay, now this is not to say don't be W-2 and W-2 sucks. Like your wage is your wage, right? But it is to say know that that's the case and know that if I'm W-2, it's going to be more work. Okay, now the other type we have here, like I said, is 1099 or K1. Okay, 1099 or K1. This means that I'm going to have commissions or self-employment income or 1099 contractor income. And because of this, I can claim more business expenses. So if I'm a 1099 salesperson, I can say my vehicle and my office space and my meals and my cell phone and all of this stuff that the W-2 guy also spends money on is for my business. And because it's for my business, I can write it off on my taxes because it's a cost of doing business and it's a cost associated with the way that I earn income. So I can write off more business expenses. I can do the same thing here if I'm a K1. A K1 just means that I have an S corporation and I'm paid as a shareholder. But same thing, I can say, hey, these are all costs of my business. As a cost of my business, I'm going to write off these expenses that I couldn't otherwise write off. Okay, I'm this. Personally, I'm this. I write off my office space. I write off my home office. I write off my vehicle. I write off my cell phones. I write off my meals. I write off my travel. I'm in Los Angeles right now. I've been writing this whole entire trip off. All of this stuff is deductible. Whereas if I was a W-2, I couldn't write off my car. I probably couldn't write off my home office. Okay, because I would be working a job for a person. I probably couldn't write off my trip down here. Okay, I couldn't write off meals. I couldn't write off my entertainment. Like it's very much more restricted. Okay, so just to give you that split on, okay, there's taxable income, but there's also how did I earn it? Did I earn it as a W-2 or did I earn it as a 1099? Okay, now what I want to do is I want to show, because a lot of you guys are W-2. I want to show the W-2 guys how to do this, right? So you have your W-2 income. Let's say it's on this side. Okay, this is the W-2 side. Okay, we can do something called Schedule C losses. There's something on a tax return called a Schedule C, and a Schedule C means that I have a hobby business that I suck at. Okay, I have a multi-level marketing company. I have a sales company. I have a marketing organization. I'm an artist, whatever it might be. I'm an Uber driver and I get paid as a 1099, and I have income, and I don't even have to have income. I just have to have intention to earn income, but I'd have expenses too. And the expense associated with my side hustle far outweighs the income. Okay, it far outweighs the income, which means that I'm operating every year at a loss. Okay, if you're a W-2 employee, this is gold. You need to be doing this, and you need to be doing it ethically and legally. So don't just be like, oh yeah, I'm writing off my home office, but then you don't actually have a business or the intention to have a business. If you have, and this is like for my clients, they're all, you know, affiliates with my company. They can become an affiliate. As an affiliate, they could have a home office for Wealth Dynamics and say, I work from my house, marketing on Facebook and social media and to my friends and family and sphere for financial freedom. And I help, you know, refer people, but I'm really bad at it. And so I have my office expense and I have my phone expense because I'm on social media, and I have my meals because I'll go out to eat and I'll prospect and I'll market, and I've got travel because I go to trips that I can learn, you know, how to do things and how to improve. And I've got costs of goods and licensing because there's services I've got to own, and there's licenses I've got to have, and there's fees I've got to pay in order to be an ambassador. And these are all expenses that I was probably going to have anyways. But because now I have an income opportunity, these expenses give me a loss, and I can offset my income with this loss. Right? So I have a client in New York. He made almost 200 grand last year, W-2. Single guy. Okay, he's watching. He knows who he is. Single guy, almost 200 grand. And so we looked at his income and we're like, dude, your income is way too high. And I know that he has, you know, an affiliate business with me and he does some other stuff. And I was like, hey, let's go back. Let's find out what you spent on these business activities and let's write them off on your taxes. So we ended up finding about 10 grand, 10K in things that he forgot to write off. And so we're going to go back and amend it. And he's going to go from being in this bracket, right, 32% down to the 24% bracket. Okay, so we just saved him, what is that, 8 percentage points on his taxes. All of this income was going to be taxed at 32. Now he's going to go only down to 24%. right? So that's a very worthwhile thing to do. Now, the thing that you want to look at is you want to look at these brackets. So these purple lines, right? So when I'm filling out my 1040, which is my tax form, or if I have a CPA, and this should be like a sin. If you're a tax preparer or a CPA, or you're working with one, and you're not looking at this, like should be a corporal sin. Like there should be punishment for it, right? So let's say that, and this actually happened, the bottom of this bracket is 105 grand. Meaning if I can earn less than 105 grand in taxable income, I go from a 22% bracket down to 12. Okay. I had a client, this was like 2 or 3 weeks ago. He was at 111 grand, literally $6,000 above the limit from being down from the 22 down to the 12. I wanted to shake his CPA. I was like, how? Because that's the first thing you should look at. How close is this person to being in the lower bracket, and how can we get them there? And if we can find, for him, it was 6 grand in business expenses and deductions because he was a W-2 employee. So we looked at what are your losses that you had in your business that you did not claim. Can we find $6,000 there? And if we can, then we can drop you from the 22% bracket down. We can save you 22% on all of this money here. So that's what we did, right? But a lot of CPAs don't look at that. A lot of CPAs will just say, what do you make and what's your W-2 and blah, blah, blah. And this is what you're going to owe. And you don't know any better. So you're like, wow, that sucks. I don't like paying that much in taxes, but my CPA is smart. They know better than I do. I better listen. Your CPA, and not all of them, I would say 90% of them, is the tax equivalent of getting coffee at Starbucks. It is not good coffee. Think about in tax time from April basically through October, they're lined up, right? Even before April, because if they're doing returns on time, which is January 1st to April 15th, they've got 6 or 8 or 10 or 12 tax returns every single day, back to back to back to back to back to back to back. So they get yours and like, okay, let me see it, get it good. This is what you got. Good, stamp it, send it in, get to the next one. And they do that every day. And then they bury themselves in a hole for 3 weeks after tax season because they're so exhausted from their job. They work hard, bless their hearts, but they're not looking at how to save you money on taxes. They're looking at how quickly can they get the job done because they have a lot of people they're doing returns for, and it's a hectic time of year. Okay, that's not a tax strategist. That's a glorified human TurboTax. You could do the same exact thing for free. So what we're saying is you should be working with my firm. What we do is we'll say, okay, you're here at 111. We know that we can get rid of 6 grand. You're going to go down to the 12% bracket. So let's go find the 6 grand. And if you don't have it, then let's create opportunities so that you do. Right? So what are some things we could do for that? Let's talk about that. This is another thing I want to go over with you. So if we look at, that was cool. So if we look at ways that we can get deductions on income, how can we reduce taxable income? Okay, how can we reduce taxes? I'm going to go ahead and do this on text because my handwriting is terrible. Okay, so how could we reduce taxes? The first thing that I look at is losses. Okay, do we have losses? Do we have Schedule C losses that we can write off against a business, a side hustle, a hobby income, something of that nature? If we do and it's legitimate, then let's do those. Okay. Next thing we're going to do is, do you have kids, right? Do you have kids? If you have kids and they're above a certain age, because you have to legitimately be able to do this, you can pay your children through your business. And the standard deduction for an individual is $12,400. So you could pay them up to $12,400 through your business and increase the loss of your business by the amount you paid them. The business does not have to make that much money. Your business could have made $0 and you still had the intention and you're doing marketing and you're trying, but you paid your kids $12,400 to help. And again, it has to be legitimate. So you do actually have to pay them a wage, and it has to be something you can prove if you get audited. But if you can legitimately do that, then you can show losses. I have a client that's got 7 kids. 7 kids, right? So if he says, okay, good, we're going to start a family management entity and it provides management services to the household, and the kids work in it as the business, and they scoop the dog poop out of the yard and they fix the lawn up and they make the house look good and they do things for the family as a management service, I could write all that off. because I'm paying it to them. Now I'm actually having to pay it to them and it's theirs now, but I can reduce my taxes substantially by doing it that way. Okay, the other thing that I can do here, I need to be looking at an HSA contribution. Okay, this is called a health savings account. Now you want to do this a certain way. It needs to be self-directed. So we're going to say self-directed, meaning you can invest that in gold and silver and real estate and private placements. But this is another one where I could get, I think $7,200 for the family if I'm married, right? So I can put in like 7,200 or so. And I think if I'm single, then it's like closer to like 3,500. And we can confirm all these numbers on Google, right? But if I'm single, that's another 3,500. And what this does is this gives me the ability to deduct that off of my taxes. So if I'm married, I can then write off another $7,200 off of my income to reduce my taxable income. If I'm single, I can write off another 3,500. Okay, the other thing I should be looking at is IRAs. Okay, IRAs, and again, these should be self-directed, meaning I'm not giving money to Wall Street, right? So that's also self-directed. Depending on my adjusted gross income, there are limits for this, but if I qualify, I can put in up to $6,000 per year per person, right? So if I'm single, if I'm married, then I can do up to $12,000 per year. Let's put M there for married. So that's again another opportunity. If I'm a married couple, that's 12,000 plus 7,200. That's 19 grand I just reduced my taxable income by. So let's look at our tax triangle here. If I was here, let's say that I was at the the 120 marker. Let's say I had 120 in taxable income and I was going to pay income tax on that. I could then write off this and I could write off this, right? And it's going to drop me from the 22% bracket down to the 12% bracket. Now, if I also had 3 children, that's another $36,000, right? So if I had 3 children, then I could drop it even lower because I can then write it off from the 105. Now, 36 grand doesn't quite get me down to the next threshold, but I'm still saving 12 cents on the dollar every time I do that. Right? So this is about using the tax code. These are all things that are allowed in the tax code. They're not illegal. There's nothing sketchy about them. Yes, you need to be ethically doing them and actually have like validated, documented proof that they're happening in real life and the intention for them to be real, but you can do them. Nobody talks about them because people don't understand the tax code. And again, like the EA, the enrolled agent that you hired, the CPA you hired, they don't see this as their job. Okay, they see their job as actually primarily staying out of trouble with the IRS. That's the main thing they're looking at, is staying out of trouble with the IRS. The second thing is getting your tax return done on time. And the third thing is getting caught up on all the other ones they're behind on. You're solid fourth. Can we get their taxes down lower? Maybe, but first let's stay out of trouble with the IRS. Let's get the return done on time, and let's get caught up on all this other shit we have this year because we have too many people coming through the doors. And if we can, then we might throw them a bone and look for ways to reduce taxes. Okay, so this is very important stuff to know. Now, one distinction that I want to make here, this goes back to the blueprint. So if I have debt, right? So if I'm here where I still have debt, I don't need to be worried about tax planning yet, right? Because what we're going to talk about is we're talking about percentage of income. So if I have a debt to income ratio, meaning the percentage of my income that goes towards debt of 10 or 12 or 15 or 20%, I don't need to be worried about saving 12% on taxes. My higher expense per ratio of my income is actually my debt. Therefore, it's more profitable for me to pay off my debt right now. Right? Even if my debt to income ratio is like only 5%, I have to look at the other factor of the taxes are only this year. If I get rid of the debt, I'm saving interest every single year now for the term of whatever that loan would have been. So it's still more profitable for me to pay off my debt. So before I do any advanced planning and trying to reduce taxes, my goal, unless they're really easy layups, right? But my goal should be to get my debt to income ratio down to 0, so that I don't have any money going towards the taxes. Now I've freed up all this income so that I can fund the IRA and I can fund the HSA and I can pay the kids and I can have this money going elsewhere. Because it's great to have these strategies, but if I'm broke, I don't have 12 grand to put in IRAs, right? If I don't have, $7,200 to max out an HSA, it's not going to help me one bit. So my goal should be, let's get rid of the debt first. Once the debt's gone, then I can focus on trying to reduce my taxes. Okay, and you're gonna feel the angst of, man, I want to do it. It's cool because it sounds awesome to reduce taxes. Part of the penalty for doing stupid crap and getting in debt is you've got to deal with the stupid crap and pay off the debt, right? So we're gonna handle that first. Now, the other thing that we're gonna look at here, guys, is, let me clear off the whiteboard here. The other thing we're gonna look at here is if you are a business owner, right? This is something that I didn't learn right away, but if you're a business owner and you file with an LLC or a sole proprietorship, you are paying taxes twice. Okay, you're paying taxes twice. So let's say I have a business where I do, let's say, real estate. I'm a realtor and I sell homes, right? And I do that through an LLC, and I don't do any special filing on the LLC. I just do my LLC, right? I'm going to pay income tax on every dollar of profit that I have. So again, if we go back to the chart, my adjustable gross income minus my standard deduction, that's my taxable income. That's even the case if I'm a business owner. And I'm also going to pay something called self-employment tax. Okay. So my income tax is whatever my bracket is. So let's look at the chart again. Let's say that I'm a single realtor and I sell and I make 85 grand a year. That means I'm in a 22% tax bracket, okay, for my income, right? So if we look at this, my income would be taxed at 22%. And then also, because this is self-employment income and I'm not filing correctly because I'm just an LLC or I'm just a sole proprietor, I'm going to pay an additional 15% in self-employment tax. This comes out to about 15%. Now, what this is if you're an employee, you know how your boss, when you do your paycheck, he pays for some of your Medicare and Social Security, and then you pay for the difference. Well, if you're an employer, if you're self-employed, you're the boss and the employee. So you pay both. You're paying 15%, about 7.5 or so on one side, 7.5 or so on the other side. So you're paying double taxes, right? I didn't know this when I first started my business. Okay, what's 22 plus 15? It doesn't matter. The number is too much. Okay, so if I'm paying income tax on all of my earnings and self-employment tax on all of my earnings, let's say I also live in a state that has state taxes, I'm paying probably another 6% there. I'm getting freaking mugged. I'm getting mugged on my taxes. So I want to show you, if you're a business owner, how do we overcome this? So if you're a business owner, what we're going to do is we're going to incorporate. We're going to form a corporation. And what we're going to do here is we're going to have two streams of income. We're going to have what's called a salary. And then we're going to have what's called a K1 or a bonus or a draw, right? So the salary, this one I do still pay income tax on. So I pay income and I pay self-employment tax. So I still pay both taxes on this, but I can make this number as little as I legally can. So let's again say I'm a realtor. I can go look at what does the average realtor make, right? I personally make $85,000. We already said that, right? But let's say that the average realtor only makes 20 grand a year. So I can say, okay, well, I pay myself 20 grand a year on salary. So I'm only going to pay the double tax on 20 grand. Okay, the other $65,000, I'm going to pay myself through a K1. This one, I only pay income tax on. I don't pay self-employment tax on this money, right? So I just saved myself 15% by setting up a corporation and flowing the numbers through so that I don't pay full tax, double tax on all of it, and I only pay on one portion. Okay, so this is what I'm doing if I'm self-employed. This is if I own a construction company, a flooring company, a carpet company, a financial services company, a real estate agency, a marketing firm. It does not matter. If I have self-employment profits, I need to incorporate. Otherwise, I'm going to get killed on taxes. Okay, this is another one where I see all the time people get stuck and they can't do anything because their CPA didn't look at their return and say, you have self-employment income, why haven't you incorporated? Let's do that for you. No different than the IRA conversation. The CPA should look and say, you're not ready to file. Let's file an extension. Let's go back and get your IRA funded before the 15th of April, and let's go ahead and get you done. so that you can write off the 12 grand, or you can do the incorporation, whatever the strategy might be. But this should be happening on your taxes. If it's not, you're paying for nothing. You're paying for something you could do on TurboTax. I freaking have apps that can just file your taxes. It's robots. Like, you don't need somebody to do it for you if they're not doing strategy like this. Now, the other thing that I want to discuss here, guys, is how we do this like in a flow on an annual basis. So what you should be looking at is you have beginning of year and you have end of year, right? You should be looking at the beginning of the year, right? And you should be doing a projection of what am I going to earn. I know that doesn't look like it says projection, but that is ancient alien cave writing, and it really does say projection, okay? But you should be looking at a projection of what am I going to earn this year, okay? Based on what I think I'm going to earn this year, what's the strategy? So I put a strategy in place to cover me throughout the year. And I work that strategy. That strategy can be to have a corporation. It can be to fund a 401k, a self-directed 401k, not a normal one, IRAs, paying the kids, setting up a marketing company, whatever it might be, like things I'm going to do throughout the year to reduce my taxes. Now here, this is around October. We're going to look at profit and loss. Okay, because here we said we're predicting. What are we doing? What are we looking at the beginning of the year? And then here around October, we're going to look at what are we actually at? What are we actually at? And based on what we're actually at, we're going to see between now and the end of the year, what do we need to do here in order to pay no tax or little tax, right? So this portion here is where we're going to throw a Hail Mary if we need to. Let's say, like, I have a client that earned more income than they thought they were going to. And we get here in October and we realize they have more money than they thought they would have. That means that they're going to have a higher tax liability than we expected. Between October and the end of the year, our job is to creatively reduce their taxes by every legal means possible. Okay, and there's some crazy stuff we can do here, but we can't do it for last year. We have to do it for this year, which means we have to actually look around now, October, November, for this year, and then say, what do we need to start doing proactively to reduce our taxes? Because after the end of that year, there's not very many things we can do to help. There's a couple, but not very many, right? So if this isn't happening for you, then your taxes are reactive. If I'm filing just whatever I have at the end of the year, and I'm not looking at a beginning of the year strategy, an end of the year game plan, executing on the plan, working the plan, measuring it, then basically I'm reactive with my taxes. I'm going to overpay, and it's my fault because I'm not doing anything to not pay, like to not pay less. I'm just basically ignoring it and hoping everything works out, right? Now, if I'm doing this, I'm being proactive. That's the difference, proactive versus reactive. Okay, and the severe disappointment is that CPAs, it's just not their job to do this for you. They don't look at that as their job description. They don't think that they're supposed to be reducing your taxes. They think that their job is to make sure that they don't get in trouble with the IRS, that your return gets filed on time, that they get caught up on all their work, and if they can, they'll recommend you do an IRA or something stupid like that, and that's it. Right? So guys, this is the basics and the fundamentals, and everything comes down to this chart. Where am I at on this chart? What is my actual taxable income? How do I get it lower? And how do I do it in legal means, ethical means, using the tax code to get it lower? And it should be an ongoing strategy, because when I'm debt free, right? We go back to paying off debt. When I'm debt free, my highest expenses become housing and taxes, right? So if I can reduce my taxes, I'm going to, because I want to get that all the way down to zero if I can. And there are ways to pay zero. Taxes are 100% optional. You just have to know how to not have to pay them, right? So guys, what I want to do here, let me flip this back around. What I want to do here is I want to open this up for questions. Okay, so if you guys have questions on tax planning, drop them in the comments. I want to make sure we answer those for you. I will hit Instagram first, just because I know you guys have a expiration on how long Instagram actually stays on. But basically what I want to do is go over questions and make sure we get you guys some answers for those questions. All right, so Instagram, let's see what we have here. Thank you all for watching, by the way. It's great to see everyone tonight. Someone says, I like paying taxes. Just get off the stream. It's not for you. Uh, Redneck Nation, not quite. Uh, very close to Redneck Nation, but those are back in my high school days. Uh, can you save this? So this is going to be, that's a good question. This is going to be saved on YouTube. So if you go to my YouTube channel, just Jerry Fetta, you'll see this tomorrow. You can also go to Wealth Dynamics University. That's our online portal. If you go to membership.jerryfetta.com, you can get a free membership to that for 2 weeks. Again, if you guys are in the comments right now, this is the time to ask your questions. Drop them. Someone says, I remember that my first paycheck, someone told me that I was supposed to get all my tax money on my return since I was under 18. Yeah, tax returns, that's the other one. And you guys are all more educated in this, I hope. A tax return is not a good thing. If you're getting money back from the IRS every year at the end of the year, or March, April, whenever you file, that is not a good thing. Okay, that means that they stole, because let's be clear, it is theft. They stole more than they should have, kept it all year long, paid you nothing, and then gave it back to you at the end of the year so that you could act like you just won the lottery. That's like, you can actually correct, it's called your Form W-4. You can correct your Form W-4 and have them give you money back every single month. Okay, I don't know about you, but I would rather have, the average American gets about a $3,000 a year tax return. I would rather have 250 bucks every month that I can use in my life, in my business, in my investments, or paying off my debt, than to get 3 grand once a year that I'm probably going to blow on Disney World or a TV. Right? So never, ever, ever celebrate a tax return. That's a terrible thing. Let's see if we have any other questions on Instagram. I'm not seeing any questions yet. Nothing so far. Again, if you guys have questions, drop those in the comments. There's a lot of questions in Arabic. I wish I could speak Arabic. Maybe at some point I will be able to. No questions, no questions. Here's a good one. How long is the process to incorporate? So the process to incorporate, and that's actually something my firm does. So we'll help you do all of that. It can be 1 to 2, maybe 3 weeks, depending on your state. Right now, because of all of the craziness going on in the world, a lot of state governments are backlogged and people are working from home and everything is moving slower. So we're seeing the incorporation process is taking a little longer than usual. Typically, it should only be about a business week. We're seeing it might even be 2 to 3 business weeks, depending on your state. So that's the process. And again, guys, when you incorporate, there's a lot more to it than just applying on the state website. So hire a professional. That's why we do it as a service. It should be a part of your strategy. You should have somebody helping you build it, integrating it with your taxes and your investments, your assets, keeping you compliant. All of those things should be happening. And so that's something we help our clients do. Someone says this is very good information. Thank you. I'm glad you're liking it. How much does it cost to incorporate? How long does it take? So cost, depending on your state, there's typically a state filing fee. Some states are $300, $400, $500. Generally, you're going to pay anywhere from $500 to $1,000 to have someone do it for you, plus whatever your state fees are. And then you usually pay a few $100s a year for like annual filing, registered agent services, that type of stuff. All right, cool. So guys, I think that's all the questions we have on Instagram. So what I'm going to do is I'm going to switch over to Facebook and answer some questions here too. And what I want to hit really quick as well, before we wrap up on questions, back to the brackets thing, because I said this at the beginning and I want to give some clarity. During the political season, you're going to see a lot of people campaign on, we're going to tax the rich and give the money to you. The rich don't pay taxes on normal brackets. Okay, there's something called a capital gains tax. Wealthy people don't make earned income. They're not W-2 employees. They make some, but typically they're going to make capital gains, right? So capital gains, they're paying like 15%. right? There's deals like oil and gas and conservative easements and what is another one? Captive insurance agencies that as an accredited investor, I can set up and funnel money into and pay little to no taxes. So the idea that because we bumped the bracket up to 40%, all of a sudden the world's problems are going to be solved is not real. The wealthy people don't pay that bracket. Yeah, it's cool that it's there and it's for show, but they don't actually pay that bracket. So let's not kid ourselves. They're not using nothing, like they're using the tax code to not pay. A lot of times their tax rate is lower than mine and yours. Right? I know a guy that he's a client of mine. 2 years ago, I did his plan and I saw that he makes several $1,000,000 a year and he pays less in taxes than my employee who is only making about 60,000 a year. He's not paying 37%. So don't fall for the old crouchy white guys that are, we'll take the money away from the wealthy people and give it to middle class America. It doesn't happen that way. Middle class pays the highest bracket. They pay the highest percentage of income, period. Right? So I want to share that with you. Let's see what else we have here in the comments. How do I get rid of this? Okay, here we go. Let's see what else we have here in the comments. So this is a really good one. So David is asking, if it's not your CPA's responsibility and you don't know how to figure out taxes, who do you hire? Okay, that's where you hire a tax planning firm. That's what I do. So you would hire somebody like my firm and we'd actually look at your taxes. I have a client about a month ago. We looked at his taxes, we put a plan together and we found out that we could get him about $20,000 back by amending his taxes that his CPA missed. Okay, he worked with her or him, whoever it was, and that person looked at everything and said, let's file it. And then we looked at it and we're like, yeah, we can get you about $20,000 back by filing it this way instead. So you would actually go to a tax planner, and that's what my firm does. So if you would like information on that, just reach out to me in the comments. All right, let's see. Edgar, that's right. There's no billions bracket. Marcy, yay for all the kids in Utah. You guys could definitely get some write-offs with all the kids. Griffin, when you're driving, do you mostly count mileage? You can't count gas, but you can count oil changes, right? So Griffin, you can count, so you can do mileage. You can also do vehicle costs. You could do gas like per gallon. What I do is called a section 179. And basically I write off my entire vehicle purchase price. I don't track the mileage and all that stuff. I basically just write off everything. There is an app though that I'll show you where it could track your mileage for you if you want to write off mileage. All right, let's see what other questions we have here. Let me go over to Zoom. Zoom has some questions tonight. Plenty of questions on Zoom here. Good to see everyone tonight. Brad, good to see you. Brian, good to see you. Nano says that's effed up on a W-2 being a direct collection, pay it from your paycheck from the IRS. It's true. Like you can go look that up. And what's funny is it's purported and pitched like they're protecting the employee. It's for your protection, protect you against your employer. No, it's a mousetrap, and that's the cheese, and you're getting in the mousetrap voluntarily. Let's see what else we've got here on Zoom. Is taxable income tiered? For example, is someone making 170K a year and single, is all taxed at 24% or only the 97? So it is tiered. It's the chunks, right? So only from this number to this number would be taxed at 24%. Then below that, you've got the next bracket down and the next bracket down. So it is a tiered system. Matt Eddie, I'm not sure what you're typing. Shoot me a text or another comment here. It's kind of just jumbled up. Are there any advantages of W-2 versus 1099? No, not from a tax planning standpoint. W-2 income really is the worst type you could have. If you and it's a thing where you can't get out of it. If you have a boss, they're generally not going to switch you to 1099 just because you asked. So that's where I'm saying have a hobby income, a side business that you can write off losses. And eventually, you know, the point of investing and doing all the stuff we're doing is getting you to a point where you have more passive income coming in than your expenses and your income at work. And you could quit the W-2 income and then you can live on just passive. Then you can have all the tax benefits you want in the world. Nano asks, why is being single a bad bracket to be in? What happens if I don't spend the 12,400 the IRS gives me to deduct? So single, you just have a higher bracket. Like if you look at just again the triangle, you're going to pay higher. Like your income threshold is higher for single than it is for couples. If you take the income on a single filer and you look at how much you earn per bracket, you get taxed at a much higher rate. Again, the IRS and the tax law is designed by, you know, business owners. It's designed by wealthy people, and it's also designed, you know, sometimes because the government wants to incentivize something. So if they want to incentivize marriage and kids, then they're going to give tax deductions and benefits and reductions in brackets to married couples to incentivize marriages, right? So that's a reality. We're not going to talk about whether that's right or not, but that is something that happens. What happens if I don't spend the 12,400 that the IRS gives me? So you're going to get the deduction anyways. So you don't have to spend 12,400. You could literally spend zero and still write off 12,400. What I'm saying is if you want to itemize as a W-2 employee or even as a sole proprietor, if you want to itemize your deductions, you would have to spend more than 12,400 as a single filer in order to actually get enough to write off and do that. For employing kids, do they have to be living at home or meet the definition of a dependent? There's an age group on that. So excuse me, I can send that to you, Keith. They have to be between a certain age limit. I think it's like the minimum is like 3 or 4 or 5 years old or whatever. And I have some clients that get away with doing it younger, but again, it has to be legitimate. And I think it's up to like 18 or 22 or something around that range. So that's again an age bracket that makes them eligible to pay them and write that off on the income. They don't have to be living at home. They do have to be in the age group, and they do have to be qualified, actually doing a job for you that's being compensated on a real basis. All right, let's see what other questions we have here. Griffin says, if I own versus lease, is it possible to do a lease with myself with my LLC so my LLC can pay and I can write it off? Absolutely, you can do that. So if you lease, you can write off the payments. Now, the difference between leasing and what I do, leasing, if I'm paying for a car and it's $500 a month, then I can write off $500 a month. That's it, right? As it happens. So that's leasing, and I can only write it off the percentage of time I used it for my business. So if I'm driving 80% of the time for my business, then I can only write off 80% of the lease payment. What I do is called a Section 179 deduction, which means I'm buying a vehicle that weighs over 6,000 pounds. Okay, it's an SUV. I'm going to buy it in December because again, I can only write off 100% of that year. So if I buy it in December and only drive it for business the final 2 weeks of the year, then it was 100% that year. By doing a Section 179, I can write off the entire purchase price of the vehicle the year I bought it, even if I'm financing it. Now, I don't finance it from the dealership. I finance it through my Sacred account. So I'll borrow, 70 grand from my Sacred account. I'll buy my BMW, and then I'll buy that in December, only drive it for business the final 2 weeks of December. And then I write off 70 grand against my taxable income. And it has to be business income. So my taxable business income that year. And that gives me that deduction. So weigh your options on that. That's something we can talk about, doing a lease versus doing the Section 179. They both are deductible, but I've seen personally better tax benefits by doing the Section 179. What about a retired parent on that same question? So okay, the employing thing. So technically, you can employ anyone, right? Like it doesn't have to just be a kid. You can employ anyone. It's what am I employing them for, and is it legitimate? And basically, you can write it off for you. The reason why we say 12,400 for the kids is because that's the standard deduction. So you want to avoid your kids paying taxes, right? So if you did have a parent that's retired and you were like, hey, I'm going to have my dad help me out in my business and I'm going to pay him $12,400 in wages and it's legitimate and he's actually doing work, then you get to pay him and then he has a standard deduction of 12,400, so it washes, right? You can also contribute into an IRA on his behalf. So if you're like, hey, I want to pay him 18,000, let's do the standard deduction plus the 6,000 IRA. That's 18 grand that I could pay my dad. Or if I'm doing a 401k, that's 18,000 or 19,000 just in the 401. So then I can bump them up to like 25,000. So it's not so much that it has to be kids. That's just an easy one for people because people have kids and you can employ them and it's legitimate and easy to do. But if you're a business owner, you can employ anybody, and anybody that you employ that does work for you, that does earn a wage, is going to be a write-off to the business. Griffin says if you own a car that's 3,200 pounds, then you're going to have to settle for mileage and maintenance. Yeah, unless you're leasing it, right? If you're leasing it, that's a different story. And I think you could still write off a little more than that. Again, it's all based on your circumstances and how it's being used and how that interacts with the tax codes. It's not a hard and fast, like if it's below 6,000 pounds, you can't do anything. Because I think you still can write off like up to 18,000 of it if it, again, is 100% for business use, depending on your circumstance. But again, that's where all of this stuff tonight is very hypothetical, theoretical, but it applies differently to everybody. That's where it comes down to what's your tax return say, what does your income say, and what are your circumstances, and how do we work that for your situation? Marcy, what is my business brings in the same amount of the price of the car? What if my business brings in the same amount as the price of the car? So Marcy, if you have, let's say the car is 30,000 and your business brought in only 10,000, you could purchase 30,000, but you can only write off the 10. Okay, the other 20,000 you can carry forward as a loss for next year. So you can still carry it forward. But again, let's make sure we're tracking that this is not revenue, this is taxable income, right? So I can't, like my revenue, I'm not writing off against the revenue because I've already got write-offs. I'm only writing off against what's going to be taxed. So it's revenue minus expenses equals my taxable income, and I'm writing off against that taxable income. So if my taxable income was 30,000 and the car was also 30,000, then I would just write off the entire 30 and pay zero. I've done that before and it's a lot of fun doing it. Let's see what else we have here. Yeah, paying off the kids again. That's a great thing you can do. I hope everyone had fun on this tonight. I love talking about this stuff. Let's see. Couple more questions on Zoom. Oh, Matt was chin texting. That makes a lot of sense. Those looked like chin texts. That makes sense now. So guys, what I want to do here is we're going to wrap up for tonight. We did run a little bit long. It was great to see everybody on here tonight. If you have questions about taxes, reach out to me, okay? Again, it is October, basically next week. So, this is the time to be doing end of year tax planning. If you have taxable income and you have little or no debt, like this is something we need to get on. Right? It's not something to put off or be timid about. And here's kind of the myth I want to break. A lot of us look at our CPAs as like revered old wizards. And we're like, I got to check with my CPA. I got to check with my CPA. I got to check with my CPA. Usually they don't know what the hell they're doing. They were trained to take a test to pay to file taxes with the IRS. They don't actually usually know about finances or investing. They're usually not financially independent themselves. It's like when you see the mechanic where he fixes everyone else's car, but his is beat up. That's how most CPAs are. So what I want to make sure like you don't think with is I have to run all of this by my CPA because of this and this and this and this, and he's my guy or she's my girl and I've been with her for 20 years. Like that's just like an outdated relationship. If they're not helping you with this stuff, it doesn't matter how long you've been working with them. It doesn't matter if they're in your BNI group. It doesn't matter if they go to your church. They are not reducing your taxes. You're paying them for a function. That function is tax reduction. If tax reduction is not happening, then go find someone that will help with it. And they'll understand. There's plenty of people out there that will pay $300, $400, $1,000 just for a monkey to file their taxes and nothing else. But we're saying we really want to look at reduction strategy and planning and being proactive. So if you're hearing stuff for the first time and you're like, my CPA has never talked about that, that's an indicator. Okay. Now, the other thing is you might be hearing about stuff you did hear from your CPA and you didn't listen to, and now you're like, oh, my CPA said that. Listen to your CPA. Don't fire them because you didn't listen to them. you would fire them or find a new one because they haven't been telling you any of these things. So guys, that's what I want to wrap up with tonight. Thank you so much all for watching. Make sure that you do like, share, and subscribe. And if you have any more questions about this, you can text me, email me, direct message me, whatever you want to do. Reach out to us for tax planning. We'll always talk to you and see where you're at. If you need help, if you're willing to pay for help, we would love to help you. I look at tax planning as return on investment. So if we can save you more than we cost, that's a win. You made money, right? So that's what we're looking for. So guys, thank you again. Have a great night. Share this out, and I'll talk to y'all later.